And we will get started. All right. Good afternoon, everyone. Welcome to the next in the series of the CoreX legal webinars. We plan to continue doing these until we run out of topics, which means until we run out of questions from people like you. This is our second. We had a program a couple weeks ago on AI. Today, we're going to be talking about raising money for your business. Uh, the next one coming up, just make a note of it, is Tuesday, August 29th. Again at noon, Brent Britton's going to be talking about intellectual property in your business, the importance of being aware of what is intellectual property and ways to protect it, because we find that that is probably the biggest issue that we run into with our early stage companies, that they either believe they've protected it or they haven't thought about it, and they get down the road and all of a sudden they've lost really a lot of ownership of intellectual property that's really valuable to their business. And as many of you know, when you go to sell your business, the intellectual property is one of the most valuable elements. And if you don't own it, you might as well not have it. But today we are going to talk about raising money. Format real quick is, in a moment, I'm going to introduce Scott Kelly. He's going to share with us some of his wisdom around all elements of raising money. If you have questions during the session, throw them in the chat. I'll moderate. If something fits really well, I'll jump in with the question for Scott. We'll also have time for questions at the end. And so I will go ahead and introduce Scott. I've had the pleasure of knowing Scott about a year, almost to the day. I think I ran into him at an event a year ago, August. Scott at the time was still living in Arizona, was traveling back and forth. And I remember when I met him, and Scott already knew everybody in town. And I thought, this is cool because you don't even live here. And because the move happened later. But I like to say about Scott is, a lot of people throw around the phrase a deal guy or a deal person. Scott's the deal guy. He's got his hands in so many things. He's bringing so much value to the business community, both here and across the country, with some of its pitch competitions. He is he's got his hand in deals. I don't even know how many advisory boards. Scott can tell you it's a lot. He's putting deals together. He's helping people raise money, find money. So he's the money guy. He ought to have a T-shirt with just a bunch of dollar signs on it in the best possible way. So with that, I will turn this over to Scott from Black Dog Venture Partners. And Scott, you tell them what else they need to know about you, and then enlighten us on raising money.
Awesome. Thanks, Jeff. I just put my contact information in the chat, and I'm going to share the screen and go over a presentation that I've done several times. It's called Raising Capital with Confidence. And just make sure I get my slideshow up here. Okay. Let's start with obviously raising capital with confidence. Let's start with a little background on me. As Jeff mentioned, I've been doing this for 30 years plus. I started on the floor of the New York Stock Exchange. I was as a runner in the early 80s, moved to San Francisco, worked as an investment banker, taking tech companies public. In the mid 90s to late early 2000s, I ran my own incubator out of San Francisco during the dot-com era, and essentially had 4X's of my own. Took a brief break, retired very briefly, moved to Arizona, started a record label, knowing nothing about the music business. Was fortunate to have a couple of gold records during those 8 years. And then I started Black Dog Venture Partners in 2008. And really, we're an accelerator. We work with early stage companies, typically technology and consumer product companies, traditionally at the seed level. So we help them raise their seed rounds, possibly their Series A, help them with the go-to-market, help them build their team, and then we hand them up to larger venture capital firms, and then eventually help them exit. My 30-year career, I've been fortunate to raise about $6 billion for other companies. I've helped another 30 companies exit over those last 30 years. And as I said, Black Dog, we built a large network of investors, 13,000 our syndicate, and about 40,000 other business partners, media contacts, and the like. So that's just a little bit about me and Black Dog Venture Partners. So what I want to talk about today is preparing for fundraising. And I think Jeff will attest to this, is that, every successful end starts with starting correctly. And what I want to go over today are some of the key elements and provide some key opportunities and tips on how to go out and raise that capital for your startup or your business. So I'm going to go over a few topics today. 1, know your investor. 2, know your numbers. 3, know your equity. 4, know your pitch, and then how to put it all in one place. So let's talk about investor outreach first. I've learned from my experience that you need to build your pipeline of investors. And what I mean by that is you need to go research who your potential investors are and do your research ahead of time. There are great resources like Crunchbase, PitchBook, AngelList, Founder Suite, Signal, and others. Do your research first. I tell everybody before you go out on a fundraising campaign, you should have at least 100 qualified investors that you can outreach. But you also want to make sure you're hitting the right investor. You want to make sure that they are involved in your sector, your vertical, your stage of investment. What you don't want to do is you don't want to be an early stage or seed stage company talking to large venture capital firms. You'll waste their time and you'll waste your time. And then you want to find out what their check size is. Again, do your homework and find those. There's a lot of resources to find those investors, but build a list specific to your fundraising goals and the type of people you want to invest in. Yeah, because not only, and especially in the early stage, not only is it important to find the money, but to find money that has something else. Someone who has not only the ability to help you finance your business, but maybe has something within their relationships or their database or the connections that can be more than just dumb money. And so you really have to start with building an effective list of the right investors. And then you go out there and build some communication. Start with some personal outreach to LinkedIn, websites, events. Now, a little piece about LinkedIn. I will tell you, and I'm sure Jeff has had the same issue. Do not, for the love of God, connect with somebody who's an investor on LinkedIn and then immediately message them your pitch deck. That is the fastest way to lose them. Okay. You want to build a relationship with them. There's an old saying out there that if you want money, ask for advice. Start asking for advice for some of these people. And so go out to LinkedIn, go to their own website, do some homework, reach out to them through their contact, go to a lot of events. We actually, I'll talk later about the pitch events that we host, but there's all kinds of events locally and nationally hosted by accelerators, incubators, startup studios. They're out there. Make contact with these people because you want to know them from a personal standpoint as well as a professional standpoint. Because at the end of the day, especially in early stage, it's your relationships that are going to make the difference. If you think about this, investors get hundreds of pitch decks and emails a month. I get hundreds a month. The ones I'm going to be more inclined to open are people that I have a relationship with as opposed to just a cold email. And then go get some warm intros from other angels, advisors. Probably one of the best ways to find a good investor is to research other successful startups in your space that have raised money. Go out there and find out who are their investors. Maybe ask them, can I get an introduction? The reality is you more than likely could. So again, it really starts first with knowing your investor. Build a list of target investors that are interested in your space, are interested in your stage of investment, and then can provide some value add. So that's step number 1, know your investor. Step number 2, you got to know your numbers.
Scott, yeah, quick question from me on that point. I've often heard, and you alluded to it, that if you want to go raise money, you got to be prepared for a lot of no's until you get the yes, which suggests it's a high volume play. You got to talk to a lot of people to find the right one. And by the same token, I hear you saying be really targeted. So where's the intersection of you might have to reach out to many, but target? Can you just talk to that?
Absolutely. It's honestly, it's both. You have to target, but you have to target at scale. You do need to have a lot of numbers. The reality is, I equate fundraising with baseball. If you can bat above 200, you'll make the league. If you can bat 300, you're in the Hall of Fame. So it's purely a numbers game. Now, that said, it's part of how you communicate that too. Obviously, as you get to those no's, this is the oldest sales trick in the book. You just ask them, who do you know? More cases than not, when an investor says no, that whether it's their guilt or their generosity, they're more than likely going to refer you to somebody if you ask. But yeah, Jeff, it's absolutely, it's hundreds of phone calls. Could be hundreds of conference calls and Zoom calls and one-on-one meetings. It is a volume business. You can't be discouraged because your goal, quite frankly, is to get your lead. Once you get your lead investor, then they help set terms, and then they help facilitate the other investor introduction. So absolutely, it's both wide and narrow at the same time.
Thank you.
So obviously, after you know your investor, you got to know your numbers. They are going to want to make sure that you know how to make money with this business. They're going to ask you for terms like MRR, your monthly recurring revenue, annual recurring revenue, any one-time revenues from pilots or proof of concepts. What's your customer churn? How long do they stay as clients? What's your monthly burn? How much are you losing every month or spending every month? And how much money do you have? And how long can you go with the money you have? And then you're going to be asked things like average contract value, contract length, consumer acquisition cost. Later on during the seminar, I'm going to give you an opportunity to reach out to me. I have a complete list, a complete glossary of terms that was generated by Tech Coast Angels, who I am a member of every financial term and financial acronym an investor was going to know or going to ask you. It's probably a good idea that you at least know these acronyms. The last thing you want to do is ask somebody what your LTV or CAC is, and you don't know what LTV or CAC means. So at the end, you can reach out to me, and I'll make sure you get that as part of the startup tools that we offer. So obviously, once you know your investor, you want to know your numbers. And I'll talk about the process in just a couple of minutes. So, and that's going to help you create all these information you get is going to help you create your financial model. That's going to tell you how much money you should raise. Now, raising money and the amount of money is some art, some science. This will help you get close to how much money you're going to need, because they're going to ask you how much money you're going to need and what are you going to use it for? How are you going to spend that money? What's going to be the use of proceeds? The financial model and doing your numbers right will ask you what your hiring plan looks like. How are you going to staff your team? What is your acquisition channel? What is going to be your go-to-market? How are you going to acquire new customers? And how are you going to get to those customers? And then as an example, how many customers do you need to hit 10 million in revenue? 10 million is when you start to look at A rounds or B rounds. But we're really talking more about early stage, just kind of your first angel round of investment. So you want to have a solid financial model, and we have some resources and tools to help you create that.
Hey, Scott, another question on that,
Sure.
especially the early stage companies. The reality, I think the reality is if you're really early stage, you're pre-revenue, and maybe you're even in the midst of developing your MVP, it may be difficult to come up with real numbers for that. And all you have is market size, and you make projections that don't have a lot of meaning. So what advice would you give someone who's in that situation? It's really, truly difficult to come up with the real numbers. And I know when I see a deck that all it is the market is this, and all we need is 0.5%, I stop listening. So how do they
Yeah.
address that, especially early stage?
Yeah, at the early stage, obviously, valuation, especially at the early stage, is more art than science. The average last year, the average seed round valuation, I think, came in around $4.7 billion. So what you want to do is obviously you're applying an unknown future with a current ask. Having a financial model gets you closer to getting what you want in terms of valuation. But it is, in the beginning, it's a dance. I tell every entrepreneur, especially at the early stage, pick two valuations. One, that's your dream, and two, that's your nightmare. And if you can get somewhere in between, then you have a deal. Because keep in mind, the investors are getting into the deal is the easy part, getting out's the hard part. So they're going to grind you on your numbers. But again, it's all negotiation. It's all based on expectations, especially at the early stage. So I will tell you a couple of ways you can handle that. Understand, look at comps in the market. But I agree, do not use phrases like, if we can get 1% of an $8 trillion market, we'll be billionaires. that you're right. That'll turns me off in a minute. Be reasonable. And again, you have to understand the market environment too. We are in a vastly different market environment in the venture space and the angel space than we were 18 months ago. 18 months ago, quite frankly, you could put, you could have a napkin and raise capital at obscene valuations. Investors are being far more pragmatic. They're looking for companies that, even if you're pre-revenue, have a clear line to get the revenue. So I think that's important that you have an understanding of your numbers, and that is where you can have a better negotiation position in terms of valuation and investors. Okay.
One other follow-up on that, Scott. You mentioned the venture firms are going to grind you on your numbers. Do you believe that angels versus venture grind different levels? I think some people think that angels don't grind numbers. They just like a concept and they throw money at you, but speak to
Right.
that.
Yeah, absolutely. But the reality is, especially at the early stage, in all frankness, you probably shouldn't be talking to venture capital first to begin with. It's going to be strategic angels and high net worth accredited investors. These are people that, and the primary difference is twofold. Most venture funds are spending someone else's money and have an IRR requirement. Now, although angels and angel groups have some similarities, especially with high net worth individual angels, they're investing their own money. Now they may have their own value in terms of, the determination, evaluation, other things. But yeah, the reality is this is going to be a dance. I tell everybody, start a little higher than you think you can get, but understand, have a place in your head where you can land and still feel comfortable. So again, I think the reality is it's a negotiation. They want as much of the company as possible, and you want to give up as little as possible. And the reality is it's a negotiation. So it happens at all levels. But again, I think angels do act differently because they're not necessarily responsible to limited partners or investors, but they obviously are still trying to get a return on their money and a return of their
All right. Thanks.
money. Right. So the next part is know your equity. And this is obviously, I'm sure Jeff and the team have a lot to say on this. You want to have your docs together. You want to be ready to go. Those docs could be your subscription agreement, your note, everything in your deal room, which I'll talk about in a minute. You want to have a clean cap table. The cap table is the list of your investors and their ownership stake. People are going to want to know that. Investors are going to want to know, how that's going to affect their dilution or how that's going to affect the dilution of other future and current shareholders. There's a lot of great tools out there, Carta, Figure. We have some great deals with Carta. I'm happy to share them with you as we go. You're going to want to know the ownership of the dilution models. There's some of the details are really in the numbers, and I'll defer to Jeff on the legal side. But obviously, once you get to a term sheet, you're going to want to really evaluate that term sheet that an investor sends to you, because they can have anti-dilutive clauses. They can have clauses where they get their money out first before you in a number of different situations. So know how equity is structured, and have a good working knowledge of some of the types of term sheets and deals you may get presented. There's safes, notes. It could be, straight equity, could be convertible equity. There's that's a trend that keeps going back and forth. Up until very recently, safes were the way to go. Now investors are looking at more price round. So you want to understand the securities documents. But at the end of the day, it starts with a good attorney. And I'm glad that CoreX is doing workshops like this, because at the end of the day, what you don't want is to have bad paperwork and try to fix it later. And I'm sure Jeff will attest to this. The litigation later on is far more expensive than taking care of your legal documentation in advance. Jeff, you want to talk to that?
Yeah, I mean, I will tell you, it's actually sad how often this issue doesn't get addressed up front. And there's, I get it. Look, if you're an entrepreneur, you're facing, especially early stage, you've got limited cash typically, and you're facing this dilemma. Do I invest that money in my app, whatever I'm developing, my business, my product? Do I continue with development or fine tuning it? Do I invest in marketing to go to market to actually get revenue? And do I pay professionals? And I think that typically that's going to be the lawyer and the accountant. And so often we understand the other two seem more valuable. The problem is they only provide an upside, which is great. The professionals are we tend to think they're only risk avoidance, and that's part of it. But also, they can add value. If you get people that are doing it well and giving you that input, that are not just providing you with a document, that's the thing. Too many people think that, for example, lawyers are all about a document, which must mean a template. And that's not true at all, because the real value of those advisors is in the advice. That's why they're called advisors. And I will tell you, we have almost once a week, someone comes in who has not done it well in the front end, and they're either in litigation, as Scott said, or now they're trying to recover, or now they're out trying to raise money, and doors are getting slammed in their face because they didn't do it the right way to begin with. These are important discussions, because here's the thing to keep in mind. As much as we like to think about the written document is the end, the conversations that happen before that are often difficult to unring the bell. We regularly have someone who comes to us after they've talked to someone about raising money or whatever it is, and then it turns out they want to do it a little different. And there might not be a written term sheet, but they've had a conversation, and now you've got people saying, wait a minute, I thought we had a deal on this term, and I thought you were going to do this. And now you've got a relationship challenge. And as Scott said, money follows relationships for the most part in this space. It's rarely completely cold. And so anything that you do or don't do that damages the relationship in terms of lack of trust, lack of communication, is critical. So I just invite you to look at your professionals as more than checking a box, because if you've got a professional that's just checking a box, you need a different professional.
Awesome. Thanks for that info, Jeff. I appreciate that. So then obviously what happens in the process is, obviously once you build this list and you do your outreach, the fallback answer is they're going to ask for your pitch deck. And your pitch deck has to have a couple key components. You have to be willing to solve a problem that's worth solving to a lot of people. Understand that. In other webinars I've done, I talk about a company called Juicerio. They raised $120 million from some of the top venture capital firms in the country. Their problem was not worth solving. They had a juicer that worked off of your phone that could make juice in 90 seconds and cost $2,400 retail. Now, after they raised $120 million from Andreessen and some of the larger venture capital firms in the world, they put out a video showing how their $2,400 juicer can make juice in 90 seconds. And I'm sure you all know what happened next. Someone produced a video how they can make juice in 60 seconds with their $100 juicer. Moral of that story is 18 months, they lost all $120 million of the capital that was invested. So you have to have a clear understanding of the problem. That's painful for a lot of people, and painful enough to get a lot of people to want to look for your solution. Let's touch on solution. Your solution has to be able to solve that problem faster, quicker, more efficiently. So again, you really have to have a clear understanding of the problem, why your solution is the best answer to that problem. Then you got to know your competitors. And for the love of God, I'm sure Jeff will attest to this, never, ever say you don't have competition. Somebody's your competition. They may not be a direct competitor, but if they could be even an indirect competitor, make sure you know who all your competitors are. That means doing market analysis, understanding your total addressable market, how big this market is, and what piece of that market you can reasonably and logically get to. Then you're going to want to talk about traction and revenue. Now, this traction doesn't always have to be revenue, especially with an early stage startup. That could be, getting your IP secured, adding a new team member, getting a prototype or the MVP of your product or service. You want to keep looking at traction. Your team slide, but this is by far one of the most important slides in your pitch deck. Ideas are a dime a dozen. Investors want to know the team can execute on the idea. And then lastly, your fundraising. Ask for your terms. couple of things I ask to tell everyone to put in their fundraising page is a few things. One, if you or others have already invested in the company, make mention of that. Tell them how much you as a founder invested, or if other people have already invested in your company. And then the amount of money you want to ask, and specifically in as much detail as you can, how you're going to use that money. And then third, what kind of milestones can you hit if you raise this money and in what time period? So there's a lot of different tools for this pitch deck. And another thing I'll make available to you post-event, I have a number of great pitch deck templates that you can use to put this deck together yourself. And again, you may want to hire someone else to do that, but at the very least, you may want to have people review the deck before you go public with it. So basically, here's the process. You build your investor list, you do your investor outreach, you're going to get asked for a pitch deck, and that'll begin the process of the conversation with an investor. So again, once you have your pitch deck, they're going to ask for your data room. They're going to want all your due diligence material in one place. I can tell you, I've been on many calls when they have a great pitch deck and then the investor is ready to learn more and they don't have their deal room or they don't have it readily available. What happens is that investor moves on to another opportunity. You need to be ready. You have to be ready for a lot of no's. You better be ready for a couple of yeses. And you better be ready to close on those yeses. And that's where a data room becomes important. There's a lot of online tools. It could be as simple as Dropbox or Google, but there's some more advanced tools where you can put all this information. But you want it secure. If there's NDAs, you want to protect intellectual property, make sure that's available. Tracking timestamps, so you know who has access to deal room and when. And the content you want to put in it. Your pitch deck, your financial models, your historical, and maybe your projected financials, your cap table, any and all legal documents, your IP, your board docs, your LOIs, everything possible that an investor needs to do proper due diligence. And I mentioned a couple of platforms there. I mean, Carta is a great tool. Savvy is an online legal firm, but honestly, I think CoreX is probably going to be your best opportunity because you get one-on-one as opposed to a legal option. I'm not a big fan of doing some things online or on the fly or taking templates and modifying them. But make sure you put everything all in one place. So again, just to kind of recap, build your list, build a targeted list, do your initial outreach, have a pitch deck ready to go when they ask for it, because they'll either ask you to send the pitch deck in advance or have the pitch deck as part of your meeting, and then have your data room ready to go so they can begin to work through the due diligence process as quickly as possible. So
Scott, before you
Jump
go
in.
on, a couple quick questions or thoughts about the pitch deck. Because I've been to some of your events and there's some really great pitches, there's some okay pitches, and there's some lousy pitches. The one thing I want to add, and because you've seen a lot more than me, the biggest gap I see in them is, number one, rarely do they actually talk about the problem they solve. There's so much about the solution, and even often when I ask people, what's the problem you solve, they don't actually answer the question. They tell me about their solution. So I guess two things, speak to that. And also a quick question, in the order you just laid them out is not necessarily the order of the deck, but most people that I've seen, they put the ask at the end. And I like to see the ask at the beginning and the end, because I want to know how I'm listening. If someone's looking for $100 million, I want to know that not at the end, but in the beginning. Are they looking for 200? Are they looking for 2 million? So what are your thoughts on the problem? And then
Absolutely.
where do you put the money in it?
Yeah, it's so interesting on both parts. One, the problem has to be of size, has to be of consequence, and if it's personal, make it personal. The reality is we have entrepreneurs that the reason why they're building this company is there was pain for them or someone they knew or someone they cared about. You got to start with that. Absolutely start with the problem. And you got to research the problem to know it has scale. So absolutely, that's, in my opinion, it's always the first slide. But you make a really good point. In fact, we did make some modifications to some of our pitches based on some feedback. On the first slide, just put a quick synopsis of what you're raising on the first slide. So you're right. the investors can, again, and there's different pitch decks used for different reasons. At our events, we do 5-minute pitches. Other events do 10, 15-minute pitches or 3-minute pitches. So you probably want to have a few versions of a pitch deck. One, for a short presentation. Two, one that you send out to somebody. And then three, something that you would use for a longer initial call with an investor. But I agree, Jeff, I appreciate you mentioning that, because we've actually made some changes to some of our pitch deck presentations to put the mention of the ask early or in the beginning of the slide, and then provide more detail at the end. So absolutely. So again, in closing the presentation, what I want to do is let you know there's a few options that are available to you. If you want to send me an email, we have a pitch deck template that you can use. That's been used that's raised virtually billions of dollars. You can kind of plug and play your information in there, but please have people review it before you go out there with that. I have an excellent glossary of investor terms that are available. It is comprehensive. It'll make sure that when you get on a call, you're talking the language that the investor wants to listen to. And then we also provide free and discounted startup resources for entrepreneurs all the time. We have a Google Doc that we constantly update with new opportunities and new tools. So just want to let you know, obviously, Jeff's been to a few of my events. We've been hosting our VC Fast Pitch events for about 12 years. We raised about $120 million for early stage startups. We do them both online, virtually via Zoom, and in person. We have an online event coming up August 31st via Zoom, and we have investors from around the country. And then on September 21st, we'll be in St. Petersburg, Florida, doing our in-person VC Fast Pitch event. So you obviously can look more on that. And then if you do decide to register for any of the events, let me know ahead of time. I will give you a special CoreX discounted link for that. So in closing, I'd be happy to answer any questions anyone has. And Jeff, I'll allow you to moderate that and how you see fit.
I will. And just for everybody knows, as I mentioned at the beginning, I've been to a lot of Scott's pitch events, and they are phenomenal, both online and in person. Not because whether you're raising money or not, you learn a lot. If you're raising money, you certainly get a lot of opportunities to see what works well and what doesn't, and you can evaluate the decks yourself. So you can say, wow, that resonated for me and here's why, or it didn't. The other thing is it's a great way to connect with professionals in the space. I've built so many great relationships just through being a part of these. So I highly encourage you to participate and let us, what questions you got?
So if you want, you can either use the raise hand function, put it in the chat, or Jeff, we can kind of just, where you want to do that.
Let me see here, Aaron. If your new product is ready for market and you don't need funds, but a specific influencer's research or resources, is there a way to put value on that as their services investment? Well, the answer to that, Aaron, if I understand your question, what you're saying is you're less looking for money, but you're looking for influencers that can help spread the word and basically take you viral. And if you're gonna give them equity for that, you're saying, how do you value that? And if that's the case, what my first response, and then I'll let Scott chime in, is everything can have a value on it. And that's where the negotiation happens, because there's probably not in advance, you don't know what the financial return of that's going to be. It's kind of like you throw it out and say, here's what I want you to do. And in exchange for that, I'll give you X dollars or X percent of equity. And they come back and say, okay, or they want more. Now, keep in mind, they're probably not going to come back and say, I'll take less. So be thoughtful in what, you offer, but it's not about lowballing people, because then you offend people and they figure you're just trying to take advantage of them. So any other thoughts from you on that question, Scott?
Yeah, I would say, ironically enough, as Jeff probably knows, I have an influencer agency as one of our portfolio companies. And so we work with influencers. In fact, one of our investors actually owns the largest influencer agency in the country, working with YouTube and other influencers. But more importantly, to your point, Aaron, there's a lot of compensation ways you can compensate an influencer. It doesn't necessarily have to be equity. It really depends on the influencer you're trying to bring in. Is it influence to sell your product or service? Is it influence to get branding or PR? Is it influence to get in front of the right people? So I think once you define what your influential goals are, that can help to open up your strategy and how you find those influencers, how you compensate them. So that would be the best response that I can come up with for that.
And one other thing I want to add, and Scott, you talked about knowing your numbers, and it's amazing to me how often I don't know that everyone really understands their numbers and their valuation. I mean, I've even seen it on Shark Tank, where someone comes in with a really cool idea and they'll tell them what their ask is, and one of the sharks will say, how do you justify valuing your company at $20 million pre-revenue? And they go, that's not what I'm doing. But that is exactly what they're saying based upon their ask. And it's a simple thing, but to me, if you don't know that and you make that pitch, you're not going to come across favorably when you don't understand that. And I say that because unfortunately, a lot of people just don't know that.
Yep. Yep. No, I would agree 100%. And Chris has a question. What I'd love to address. I come across a lot of fraud and scam on angel investor websites. How do you get around these people or vet these people? It really comes down to doing your homework. I don't take anything at face value. There's a lot of resources you can go to. As I mentioned before, you can go to Crunchbase, PitchBook, Google them. When we're out there doing investor outreach, I make sure we know who the investor is before we even get a call them. So, and again, I think obviously, as unfortunately, Chris, the internet has a lot of good information. It has a lot of less good information. And so I'm a big believer in trust but verify. And this is where it comes down to the research. It really comes down to doing your homework ahead of time. Because what you don't want to do is go out there and try to raise capital and then have no one to talk to, and then just randomly hit Facebook or LinkedIn or go to every website. This work begins months before you start raising capital. I tell everybody, if you want to raise capital, today, do your research 3 months ago. You need to have a qualified list that you've already vetted, that you already know who they are, that you've begun to establish a relationship. That makes everything far easier down the line. So that'd be the best way to handle that question.
Hey, Scott, to that point, can you speak a little bit for everyone? We didn't talk about it today. To your thoughts on crowdsourcing platforms. That is the last 10 years, it has exploded. And I hear a lot of early stage companies saying, well, I'm just going to go do a crowdsourcing fundraiser. I'm going to throw it up there and I'm going to raise my $250,000 or $1 million. And there's other more sophisticated platforms now that are not, they're more focused on raising money for ventures. Speak to that and what people need to be thinking about when they want to go consider that way.
Yeah, absolutely. When the Jobs Act came out several years ago, it provided a real opportunity, but it didn't reduce the need to do the work ahead of time. And so you have what's called Reg CF, which is crowdfunding, which allows for your clients, your fans, or your customers to make small to large equity or other types of investments in your company. That's typically going to be for someone who has a good database of people to begin with. I tell everybody, do not assume that if you build it, they're going to come. Okay. And I don't care what crowdfunding platform you go to, they have the same database of investors that they bought and they say that they have. Do your work. Make sure you have a good database. Now, I can tell you it's a very good way to raise capital. And the reality is there's a lot of platforms out there. Obviously you got large players like WeFunder and StartEdge and Republic on the crowdfunding side. You've got companies that are dedicated to Reg D. You've got companies like Raise Finance, who we work with, Republic and others. But it really comes down to making sure you have your list, because you can't rely on them. Now, the other thing I will tell you people all the time, we've done this several times. We have done non-equity crowdfunding. We have done reward-based and pre-sale crowdfunding campaigns with Indiegogo and Kickstarter. And what that does is two things. One, it might reduce the need to go out and raise investor capital because you're basically pre-selling product. And two, it shows that you have product market fit for your investors. So if you have a consumer product and you've got a good fan base, Go out and do an Indiegogo campaign, raise $25,000 or $50,000 pre-selling product, and then you can go to investors and say, look, I have people that want my stuff. So I think there's a couple of ways to skin that cat.
There's another question here, Scott, from William. Says, if you've got an idea or an invention, is this something that venture capital groups are interested in funding, or do it need to be at least a finished article with numbers and targets?
I think that depends. Now, if you are a first-time founder, you're going to have more proof and more evidence that you have a viable product. It's not to say that companies and investors don't invest in ideas. But again, it comes down to making sure you have a fully vetted idea, you have a fully vetted path to revenue, and you have a fully vetted and qualified team. So I don't, there's ideas that get invested in every day that don't have a business. It doesn't mean you don't have to do your homework. It doesn't mean that's where putting together a pitch deck. So even if you're making projections on pre-revenue, you at least have some validity to those projections. And that's where it comes down to doing the research. If you've done the research to the right investors, you're going to talk to investors that invested that stage and not waste your time and their time speaking to investors that want to be later stage. Yeah, at the idea level, for the vast majority, I'll call it the super vast majority, you're going to want to talk to, high net worth angels, maybe friends and family that has its good news and its bad aspects to it. But before you talk to VCs, but you still need to do the work.
So I don't see another question here. If you got another question, put it in there. But God, I'm going to ask you what might be the wrap-up question.
Okay.
Oh, Aaron's got a question. Let's go with that. So Aaron's question is, CoreX has been handling a legal matter for a new venture. Oh, thank you, Aaron. We said you mentioned your fast pitch events. Is it acceptable to have the parties at these events sign an NDA?
Okay, well, I'll give you my opinion, and then it's going to be probably contrary to Jeff. The answer is no. And let me tell you, and I'll tell you why from my standpoint. Now, are NDAs important at some point? But the reality is, if you ask for an NDA before you give them any information, think about this. If I'm an investor and I've got 100 deals in my inbox, and one asks for an NDA, I'm going to spend my time talking to the other 99. Now, is there a time and place for an NDA? Absolutely. What I would do is two things. Make sure you have your first presentation doesn't have anything that needs to be protected under an NDA. So again, because I can tell you, and really it's in my conversations with some of the largest venture capital firms in the country, that there's two things they tell me. One, the likelihood they've already seen something like yours is pretty high. So it might put them in immediate violation of the NDA. And two, they don't want to take the time and expense to manage virtually thousands of NDAs. So from a practical standpoint, it may not be, I wouldn't lead with that. But if you start to move into due diligence, it's appropriate then. That's my opinion. Jeff, you want to chime in?
Well, actually, we are not opposite. We are exactly in the same place. This is something we talk about regularly. Brent and I both talk about it. And our answer would be no. Not at that stage, because what we want you to think about is we often value the idea. The ideas are not what's valuable. There's two things that are valuable. It's the secret sauce behind the idea, or your willingness or what you bring to the table to actually make it a reality. We encourage our clients to talk about their idea at a high level. I mean, for example, at the last pitch competition, there was a phenomenal pitch, frankly, by a young man who's got something. And I talked to him after the event. He's, the money's going to come to him. And he shared the idea, and it's a wonderful idea, but he didn't give away the technology except the idea of the technology. So he even described what the technology accomplishes, but that's not the secret sauce. So I agree with Scott. It's going to turn people off. At the right time, it's the right time. If you're going to have that conversation with them, the money person, yes. But when you're just talking about it, and this is the other thing, I can't tell you how many people that I meet will say, I've got an idea, and I'll say, oh, tell me about it. They go, well, no, it's a secret. And I know what's going to happen, because 99.999% of those secret deals never go anywhere. Because what you want is you want to get people's feedback. You want people to say, oh, that sounds really amazing, or I don't understand it. So you can learn from the people you share it with. So we're big fans of share it, but don't give away the secret sauce. The idea is not the
Yeah,
secret sauce.
yeah. In all frankness, not to sound rude, I'm a New Yorker, so I'm a little bit blunt. Um, if someone sends me an email and it starts with NDA, I delete it. I just don't have time for it. So that's probably the best answer for that question.
Yeah. So Scott, one more question here. Another one from Michael. He says, you had made a comment that investors are shying away from safes. Why is that?
Well, I think the reality is what's happening over the course of the last several months before now is safes were coming in without a valuation cap. And that's not good for anybody, quite frankly. And so what's happening now, you're finding what are more called priced rounds, even a price safe. You have the evaluation cap. So they're not necessarily, shying away from safes, but they're obviously being far more pragmatic as to what the current terms are and the future terms might be. So it's a combination of those. So, but what you'll find also is, quite frankly, between investor, region to region, I spent close to 30 years in the West Coast, and safes and convertible notes were, commonplace. I came out here and a lot of investors just want to do straight equity. So I think it's, I wouldn't say they're shying away, but there's always a different, deal structure that comes out. I think they're shying away from unpriced rounds and, unknowns in terms of future commitments.
All right, great. Any other questions? This has been I've learned a lot myself. All right. Well, thank you for everybody being here. Appreciate you being a part of this. We are recording this, so I'll be sharing that either later today, tomorrow with you. No secrets here. Feel free to share it with folks. This is about spreading the knowledge so everybody can be better armed to achieve their objectives. Brent wants to know if we'll get the slides. Yep. Is that cool with you, Scott?
I'll make that available. Absolutely.
Yeah. If Scott, you send that to me, I'll share it with everybody. Appreciate your questions. And keep in mind, the next webinar is going to be on ownability and the role of intellectual property in your business, the importance of protecting it, and the things that get in the way. And that's going to be on August 29th at noon. Don't miss that one. And I will tell you, that is such a critical topic. I'm still learning so much about intellectual property from the legal side. And I can tell you, one of the reasons is I had a conversation this week with someone who went out and hired someone to develop some software for them, didn't have a written agreement, and now there's a dispute over who owns it. And they're saying, well, they told me I would own it. Aren't verbal contracts enforceable? I said, yes, but not when it comes to intellectual property. So it's important to learn. And you might actually also say this, you may not even know you have intellectual property that it needs to and can be protected. So join us on the 29th. Thanks again, Scott. Thanks for everybody being here, and look for the slides and the recording in the next day or two. Have a great rest of your Thursday.
Thanks,
Scott.
Thank you all. Thanks, Jeff. Take care.